Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Coming up, some of the stories we're tracking for you right now. BNN Bloomberg Newsroom. Shares of CIBC are hitting a record high after first quarter results came in higher than expected. Profit topped estimates, and Lender also posted better than expected results in its capital markets business. There was also record revenue across all of its units, as well as higher returns on equity. This marks the second straight year CIBC has beat expectations as the broader banking sector continues to see strong growth across multiple segments. Shares of TD Bank are also moving higher. The lender posted a profit in its latest quarter that topped estimates, as well as revenue that jumped 18% compared to the year before. TD also saw record revenue in Canada, helped by a rise in loans and deposits and strength in its wealth management and markets segment. The quarter was also boosted by a decline in the lender's provision for credit losses and higher banking revenue in its U.S. division. Shares of Gildan are down, 6%. Well, 5.88 now. It's just dropped down to the apparel manufacturer, posting sales and profit in its latest quarter that beat estimates, but shares are being dragged lower by its 2026 targets. Its full-year outlook missed expectations for both profit and revenue growth, and analysts are also pointing to the decline in net income. Still, Gildan says North American demand for its products remains strong, innerwear sales nearly tripling year over year. And quick look at the markets. Another good day for the TSX. It is on a roll right now. The bank's helping today. It is up 0.42%, well above 34,000 into record territories at this point. South of the border, bit of a different story, mixed bag right now. You can see the S&P 500 and total off by 77.77 right now. The Dow off by 0.14, but look at the NASDAQ, and that's NVIDIA dragging that down. Other AI stocks. Concerns, of course, about AI hurting tech. It's off by 1.5. According to U.S. President Donald Trump's trade representative, Canada must agree to a certain level of increased tariffs and assist in reshoring American industries as part of any potential agreement. CTV's Michael Couture has the latest.
The State of the Union address?
Prime Minister Mark Carney says he didn't watch the State of the Union address, but there are impacts for Canada. President Trump made it clear tariffs are a key plank in his economic plan for the U.S.
The view of the American administration is that there'll be a price to access the American market. I think, every country of the world that I know of is paying a price. What I'm saying is that Canada is paying the lowest price.
But that price could be paid in jobs. The U.S. Trade Representative today making it clear this is about moving manufacturing back to America.
We really want to focus on reshoring here. We want to have production here. We don't necessarily want to be dependent on China, Canada, or anybody else for things like cars and that kind of thing.
The U.S. has 50% levies on steel and aluminum going into their country and 25% tariffs on autos. It's why the Canadian government is trying to diversify trade away from our American neighbors.
GM and Stellantis have been cutting jobs here in Canada. Well, we will look towards Koreans, we will look towards Germans, and we will look towards Chinese investments.
While looking for other trading partners, Canada continues to work on saving the trade deal with the U.S. and Mexico.
The Canadians, I was in contact with my counterpart just this morning. He's going to come to town in a couple weeks. They have a few ideas on how they might want to have a deal with us. We're obviously open to that.
By comparison, Dominic LeBlanc's office was far less committal. In a statement, a spokesperson for the minister responsible for Canada-U.S. trade would only say LeBlanc and Greer had a number of brief, informal exchanges in recent days about a potential in-person meeting in Washington in the near future.
And that was CTV's Mike Couture. Up next, three more big Canadian banks reporting their first quarter earnings. We'll get some investor perspective after the break. Canada's biggest banks reported their first quarter earnings this week, the most recent being RBC, CIBC, and TD. All of them beat estimates. For more perspective, we were joined earlier by Bryden Teich, CIO and Portfolio Manager at Avenue Investment Management.
I think what's interesting is the results that the banks have posted in contrast to, I think, the general sentiment that the Canadian economy has been weak and stagnant for the last year. And I think, again, the banks in Canada are showing their resilience, and the different business models or different business segments all seem to be humming. And I think, the concern from a couple of years ago with the banks was that we were going to have a slowdown in real estate after the COVID couple of year boom. That didn't really materialize. I think there's still concerns about what a down credit cycle would look like for the banks, but you're not seeing that anywhere in the results. And so I think for now, investors in the banks, I think, can sort of rest easy. And I think, it's definitely a segment of the market that continues to propel higher. And these results in the last couple of days highlight that.
And it feels like with the housing market, it feels like they've negotiated that and found a balance and not lost customers, not lost mortgages on defaults, and that their losses were either in around expectations. A couple were even lower, if I'm not mistaken.
Yeah, I think the other thing too is you've had now a couple of years where the banks have been working through this mortgage renewal cycle from the last 5 years. I think the concern was, 2020 and 2021, you had interest rates on the floor. We then had interest rate hikes in the last couple of years, which took that renewal interest rate higher. They've managed through that very well, and I think there's still a shortage of supply in housing in Canada and all of those dynamics that the actual level of real estate has slowed down, but you're not seeing it in terms of loan losses or a down credit cycle. And the consumer is pinched, so maybe consumer demand in the economy is weaker, but everyone still needs a place to live, whether it's a home or an apartment, renting or owning. And the loans in real estate and in the banking sector have been very resilient. And I think the results continue to highlight that. I think, you can sit and hypothesize concerns on the horizon, which is always part of, the hand-wringing that goes on managing investment portfolios. But the results, I think, speak for themselves, and the diversified nature of the different business lines. When you have results like this so uniform, it makes you sort of pause. Is the economy really as bad as people think it is with results like this?
Yeah, I was going to say, can we take that and expand and say, hey, it isn't? I mean, there have been concerns. We have heard talk of recession at times, but maybe we're not in as bad a spot as possible as we thought.
The dynamic that I think is interesting to sort of parse apart is, we've been in this essentially stagnant GDP per capita economy, which means that on average, per person, economic growth in Canada has basically been flat for the last several years. But nominal GDP, the actual size of the economy, has grown. And this is part of the dynamic of adding, a lot of citizens in the last few years, and sort of the per capita growth has slowed. Yeah. But nominal GDP has still been high. And I think the way to think about the banks is they are nominal GDP businesses. And so if the economy as a whole is growing, whether that's on a per person basis or we're just adding more people to the economy, I think all of that increases the demand in the economy, which helps nominal GDP, which helps the bank results. And capital markets have been strong. Obviously, the stock market's been strong. I think you've had a strong move last year and a lot of M&A activity too, which is great for the fee revenue for the different banks. Across the board, it's been great results. I think it's, I don't think there's not much more to question really with the results that they've put up in the last quarter here. And I think the question going forward is, can they continue to maintain that momentum? And
can people be satisfied too? We're seeing it with NVIDIA now. We're going to talk probably about that in a little bit. But stocks like that, the Mag 7, where you're seeing they're perfect pretty much, or they're running about as well as they can, but people aren't happy with that. They want more. Yeah. Can we see that with the banks? And which of the banks do you think posted? Is there one that kind of stood out a little more than the others?
So the two banks that we've owned for a long time are National Bank and Royal Bank. And I think I would sort of highlight National Bank's results. I think were very strong. They reported yesterday. And I think what they've shown is a very good implementation of their acquisitions of the Laurentian Bank retail side of the business and also Canadian Western Bank. So they're now, where they had legacy at National Bank was it was sort of a regional Quebec business. They were starting to spread throughout the country. But now with their Canadian Western Bank, you really now have an across the country platform that National Bank has been building. And they continue to be one of the highest return on equity banks out there. So a lot of high fee business, Their capital ratios across all of the banks are now very high. I think the question will be, what do the banks do with that excess capital? I think, the worst thing they could probably do is go out and do a bunch of acquisitions in the U.S., which was sort of always what would happen. But they're very well capitalized. They're in a good position, I think, right now. I think the question of the economy will linger. But the only risk I would sort of throw out there is when you have bank stocks start to go parabolic, at some point something will happen to disrupt that.
Something's got to give.
And it's not, anytime you have a parabolic move in a bank stock, I think you have to be a little bit cautious to be a net new buyer today. But for anyone who's a long-term investor, I think these businesses continue to highlight their resiliency.
With National, are there any more places for them to buy, or do they have to start growing organically now?
Yeah, I think
and becoming one of the big, consider themselves one of the big banks.
I think the two questions or the concerns are always, where is organic growth coming from in Canada? It's always been a challenging environment to grow organically in Canada for the banks, which is why they've always made acquisitions in the U.S. I think National Bank picking up Canadian Western Bank and then buying the part of the retail business from Laurentian Bank tactically, I mean, they get stronger in Quebec with that acquisition, and then they get a presence in Alberta. And I think where you've seen the growth biggest in the banks is all of their non-traditional personal and commercial businesses. So they all want to grow their fee business because it's a much higher ROE, return on equity business. Yeah. You've seen the banks do that. I think the question right now is you're actually in a good spot because I don't think they're going to be going out and making a bunch of acquisitions, which was always what would happen at higher capital ratios. So they're really in a good spot right here with the results for this last quarter.
That was Brian Teich, CIO and Portfolio Manager at Avenue Investment Management. Coming up, as we continue our coverage on Canadian bank earnings, we'll have more on some emerging key themes to watch out for when we come back. NVIDIA posted blowout earnings yesterday, but investors' response has been lukewarm at best, signaling that concern of a bubble persists. Let's get more now from Jonathan Corpina, Senior Managing Partner at Meridian Equity Partners. Jonathan, thanks for joining us. A busy day, and the markets, especially the NASDAQ, not responding, are they? Or they are responding in the wrong way.
They are. Busy day. We continue to see a lot of volatility here in our markets. So it's just nothing new to us. I think when we were looking at our earnings calendar, clearly when we kicked it off, we were talking about some of the financials, then you get to some of the tech names. But the next big chapter of that was the NVIDIA earnings that came out last night. And like you said on the lead-in, they did beat top and bottom, but I think it's the outlook moving forward. CapEx spends continues to increase. I think that's causing investors to have a little pause at this point. And also, let's go back a little while. NVIDIA was that new shiny toy. Everybody was focusing on that. And now the competition is starting to catch up to them. And that's certainly adding a little bit of pressure there. So we're seeing that in the activity in trading in NVIDIA today. And now that is then couple that with all the other NASDAQ stocks, and we're seeing a lot of pressure on top of that.
Yeah, there's a lot. There's a lot of movement. Any other big names taking a hit today?
Listen, I think it's the mindset of the volatility in the market. When one of the big names moves, everything else kind of couples with it. So I think, there's some collateral damage here that some stocks are getting pulled in there. But go back to the beginning of the week, we had a really significant, a good run up in the market on Tuesday ahead of the State of the Union. On Wednesday, the after effects of the State of the Union. So again, just the volatility is back in our markets here. Month ends on Friday. Looking to end the Dow up for the month, but NASDAQ will be down. We're seeing that pattern most recently in our markets here. It's going to take a little while as we get into this year for some things to play itself out.
And with NVIDIA, is the fact that there's still nothing moving into China, is that a factor at all in this? And the comments made about
certainly plays in. Yeah, that certainly plays into it, right? The uncertainty of China's participation in top-line revenue for NVIDIA is still in question, and I think that's NVIDIA is not the only company that is exposed to that. As we continue to talk about tariffs and how that is playing out with the United States, it's going to have an impact either positively or negatively on some of these companies. And it's been quite some time, right, that we've been discussing this, and the meter on that keeps switching back and forth. So that uncertainty is going to add pressure not only in companies like NVIDIA, but other tech stocks and others with global exposure.
All right, let's talk about a couple of others. Salesforce, how are they doing? I'm just looking at what they're doing. The responses today for one of the few going up, going the right way, going up.
Yeah, I think there's a few items that are there within Salesforce. I think exposure to AI and the competition that AI can certainly put on Salesforce is one that would certainly have a negative impact on that stock. But to offset that, they've added a $50 billion share buyback, which will certainly help the stock. I think at this point they're looking for some stock price that's cheaper at this point to help for stability. The buyback will help employee repurchasing. So when you're looking at that certainly is going to help the price, but you can't always rely on buybacks. You're going to have to look on the fundamentals of the company. You're going to have to look at the forecast and the exposures of competition moving forward. So that might be a short-term bounce in Salesforce today.
And they also raised their quarterly dividend as well to 44 cents. Is that a big jump? I'm not sure what their last one was.
Yeah, that certainly helps too, right? I mean, when you are in volatile markets, like we've had for some time, investors try to find some safe havens, right? And they can find it in certain sectors. They can also diversify their portfolios by looking for stocks with higher dividends. So I think that's also very attractive when investors are picking and choosing what stocks to have in their portfolio.
All right, and everybody, of course, loves a good drama, and we've got one going with the romance between Paramount and Warner Brothers and Netflix. Paramount reporting, Warner reporting today, slightly different reports, but how is that affecting the whole negotiations that are going on?
Yeah, I think it certainly has some impact, but I think overall, shareholders are just looking for value and they're looking for timing. And as this continues to play out, this drama, it's not over. We're going to continue to see it move in this direction. We've got two companies that are vying for Warner Brothers. I think Paramount clearly has raised their bid here as of last week. This acquisition would be a vital component for Paramount to expand their streaming, expand their creation within that industry. But even that being said, whoever comes to the finish line here, we're still going to have some antitrust headwinds, both domestic and international, to get this deal done. So this is nowhere close to the story being over.
And does Paramount's report, does that make it any more appealing to Warner Brothers, or in the end is it just going to be the vote is the vote?
I think the vote's the vote, right? We can look at earnings reports. We can make our own summation about what happened last quarter and the outlook moving forward. I think the decision of what the future looks like has already been decided, and that's with having this combined entity as one. But how that plays out, how the shareholders vote, and again, there's certainly a lot of headwinds to this deal. So it's going to be interesting to watch this whole thing continue in front of us.
Yeah, lots of meetings going on at the White House today. Jonathan, thank you very much for joining us. We appreciate it.
Thank you. Have a great day.
You too. Jonathan Corpina, Senior Managing Partner at Meridian Equity Partners. And as we continue our bank earnings coverage, we're zeroing in on the standout themes emerging from the latest beats by Royal, TD, and CIBC. Earlier, we sat down with Mike Clare, Senior Vice President and Senior Portfolio Manager at Brompton Funds, and we kicked off the conversation with his thoughts on TD.
We saw pretty strong results from TD along with the rest of the banks. I think like all six banks essentially beat bottom line earnings estimates this quarter. So a pretty strong quarter from TD. I think what stood out to us in particular, first of all, results from the capital markets unit have been very strong, over 20% ahead of consensus estimates and growing at 65% year over year. Mm-hmm. So they've done obviously a very good job integrating the Cowen acquisition from a few years ago. They've been generating strong trading and fee income in that business. Along with that, I think TD, what stands out as well is they've sort of gotten back to their bread and butter of the Canadian personal and commercial banking business, with that business reaccelerating to some extent. And doing a good job there. And then, of course, they've been undergoing a restructuring both in the U.S. and broadly across expenses. That restructuring program on their expense side is now complete. So they've taken almost $900 million in upfront charges, including $200 million in the first quarter, the current quarter. And that's going to generate eventually annual cost savings of $775 million, of which we'll see $500 million this year. So lots of good things happening at TD.
Can we talk about Royal Bank? We did see a little weakness in the stock at the open, but let's check it out as we move deeper into the session. Is there something that might have given investors misgivings here?
Yeah, I think so. First of all, for Royal Bank, which we still think is the number one bank in Canada fundamentally, does trade at a premium valuation. So the bar is very high for them.
Okay.
They did have a very strong quarter, but I think if we could pick on one area of weakness is that their credit losses still remain somewhat elevated. So they've reported impaired credit losses at the high end of their guidance range for this year. Some of that coming from the capital market side, which tends to be lumpier, but then looking at different trends, leading indicators of future credit losses, I think some of those trends are a little bit softer than their peers. So looking at things like new impaired loans, we saw after several quarters of declining new impaired loans, we did see an uptick in the current quarter. And one of the things driving that uptick is residential mortgages, particularly in Ontario, where the Ontario economy, of course, has seen the impact of tariffs on auto workers and other manufacturing sector workers. So something that I think the market is one quarter doesn't make a trend. The market's going to look at that and see the beginnings of potentially some future credit losses. But the other thing to consider on the residential mortgage side is that having a loan go impaired doesn't necessarily mean you take a loss. This is a very, very strong credit portfolio with very low loan to value ratios on the portfolio. So it's not doesn't necessarily translate into losses, but it's something to watch to see if that trend continues in the coming quarters.
And how about CIBC? That stock hitting a record high today.
Yeah, CIBC, we think probably had the best quarter among the group here. Now that all six big banks have reported, their bottom line EPS growing at 25% year over year, 16% ahead of consensus estimates. And we really saw strong results across all of their business units, driven by a number of factors, including margin expansion. So net interest margins continue to grow from prior quarters. Capital markets business was well ahead of consensus, growing over 40% year over year. We saw pretty strong results from their U.S. commercial banking and wealth management segment on both volume growth and margin expansion. And notably, as well for CIBC, I think we've seen pretty strong performance in their strategy of targeting, the mass affluent customer here in Canada, which tends to be a higher profitable customer, lower credit losses, better returns. And we continue to see them grow their number of clients there with 6% year over year client growth in that business, 12% growth in client balances in that business. And so that's really, it's a strategy that the team's been working on for a number of years that continues, of course, with the new CEO in place now. And they're really doing a great job across the board.
Mike Clare is Senior Vice President and Senior Portfolio Manager at Brompton Funds. Coming up, we'll dig into today's slew of earnings from Canadian companies with David Driscoll. Stay with us. Shares in Canadian utilities are under pressure. They're off about 2.26%. Company posted net income in its fourth quarter that fell short of estimates and also missed on revenue. The energy and utilities firm says the results stem from regulatory issues as well as the wind down of a 2024 efficiency program. There was also a write-down of assets in its Alberta portfolio after repeated power curtailments due to weaknesses in the province's electricity grid. Quebecor beat revenue and profit estimates in its most recent quarter, with revenue hitting $1.5 billion. The telecom saw revenue rise in its internet and TV segments and added more mobile users to its network than expected. Quebecor's wireless brands have been offering cheaper plans compared with rivals in a bid to boost wireless subscribers. And we'll get more insight on the quarter when we speak with President and CEO Pierre-Karl Péladeau today at 1:20 p.m. Eastern. Stellantis shares have turned positive after the automaker's CEO said the company expects return in North America to improve, with the sector being the largest contributor to its 2026 profit growth. The comments come after Stellantis reported a loss tied to its North American and European units. The car maker has scaled back its EV strategy after demand in Europe disappointed and the U.S. removed incentives. And taking a quick look at the markets, the TSX well into record territory, continuing its surge up by more than a half a point. And south of the border, different story. Nvidia leading the way down for the NASDAQ. Other tech stocks taking a hit as well. It's off by 1.2, almost 1.25 points. The S&P 500 off by 0.6, and the Dow, that's about a wash right now. Well, to say investors are digesting a slew of Canadian earnings is an understatement. RBC, TD, CIBC, all of them reporting. They all reported first quarter beats. And let's get more from David Driscoll, founder, president, CEO, and chief investment officer at Liberty International Investment Management. David, thank you very, very much for joining us. We have a lot of earnings to get through. Let's talk about the banks first, your reaction to them all.
Well, my head's spinning with all the news that's come out today, Roger. But I think when you see the bank headlines, not a lot has changed among all of them. They all have the tailwinds in North America of essentially lower interest rates in the last year, which of course leads to lower deposit rates, which makes people in savings accounts very unhappy, but higher renewal rates on mortgages. So when you get that spread, you're going to have a net income margin that's going to grow, which allows them more ability to buy back shares, which they've really been busy doing. And then on the wealth management side, you're getting rising stock markets for the last 3 years, so their fee incomes continue to rise, and capital markets have been very busy simply because of the new issuance of equity and debt. Now, investors need to step back from that and say, okay, that was last year. We had 5 interest rate cuts from the Bank of Canada and 2 from the US. So what could be happening moving forward? And the headwinds that are sitting there out there could be just a worsening US economy, since most of the Canadian banks do have exposure to the US economy. Commercial lending could slow down. And then you've got that K-shape economy where those that have money are borrowing and growing their businesses. But then you have the middle and lower class where they're probably going to be under pressure on higher mortgage payments, car loans, and credit card lending. So that's the overview of all of the Canadian banks. With regards to Royal Bank, net income was up $5.79 billion, or $4 a share. Revenues were up 7.3%. The only thing that had a little scar to them was just a slight increase in higher provisions in their capital markets and personal banking. But other than that, everything was hitting on all cylinders. So go ahead.
No, sorry, I was going to say, is there, could we be getting to the point where it might be almost like the Mag 7 where they're too good?
Well, they've had these tailwinds where everything is falling into place for them. So you've had lower interest rates, a burgeoning economy. Things could slow down now moving forward. However, in Canada, inflation, if it starts to fall, leaves more room for the Bank of Canada to cut rates, which would be a positive for them. And then if you get these infrastructure building bills going through Parliament that the feds want to do, then there's enough, let's say, firepower to be able to keep the economy moving forward, and that will be good for the banks. It's just south of the border. It gives me a little bit more concern.
All right, let's. We've got so many others I want to touch on here. Move over to Stantec now. They had to beat. They're up again now. I was just looking. They're up slightly, about 2% right now.
Yeah, well, Roger, they and WSP Global reported yesterday, and the infrastructure stocks, these are essentially architecture firms, construction firms, et cetera, where they fell on the fears of what was happening in the software sector, because a lot of the design is coming from CAD/CAM software, and you've got potential disruption going on there. But in Stantec's case, they're outsourcing all of their design work to India. So costs are coming down, and we'll see what the contracts are going to look like moving forward. The stocks have been off since October, but they're starting to recover now. And again, because of earnings that came out yesterday. In Stantec's case, revenue was up 10%. The dividend was increased 8.8%. Their backlog has grown. It was up 9.5%. And organic growth is 5%, but they also continue to make acquisitions, and the acquisition growth was around 3.9. And that's what they expect moving forward, because if we do get a massive upturn in infrastructure spending and building, then both Stantec and WSP are going to be in place to benefit from it.
All right, and moving on, CCL Industries. What did just looking at some of the numbers? Sales increased 3.5%, only on 0.6% organic growth, though.
Yeah, so the sales increase was really just on currency, because a lot of their business or sales are to the U.S. So they benefited from a 5% rise last year in the gain of the Canadian dollar against the U.S. So it's a tougher time for packaging companies because, again, consumer demand has been falling. Prices have gone up. The average consumer is having to spend more on gas, groceries, and housing, electricity. So a lot of the packaging that they manufacture, demand among the consumer products companies has not all been that great. However, it is a good company. They just announced a 12.5% dividend increase. But they are going to have to deal with a slowing economy, and tariffs have hurt them as well. And that's simply because of all the compounds that they have to import. They're having to pay extra on that. So their cost of goods has gone up at the same time that revenues are kind of flattish.
All right, and we've got about 35, 40 seconds. Northland Power. Go. Sorry, go ahead. No, go ahead.
Okay, thanks. Northland did cut their dividend last year because they've had a bit of a cash crunch, and managing that cash is really the overriding theme there. So they had record high wind production across German offshore wind assets. So their free cash flow is starting to improve a little bit because of the dividend cut. However, their projects are still a few years away. The next phase of growth is in wind and battery storage projects, but the payout ratio is still rather high, so they have to really be nimble with the way that they're going to manage their businesses moving forward, or there could be another cut to the dividend again. So for income investors, they really have to be wary about this company.
All right, we'll have to leave it there, but David, thank you very much for joining us.
Oh, pleasure, Roger.
David Driscoll is founder, president, CEO, and chief investment officer at Liberty International Investment Management. Coming up, as we were just mentioning, WSP just posted a record backlog and strong cash flow, but the stock's still been hit hard. In the AI-driven pullback, you can see it's actually bounced back a little. It's up again at this moment. After the break, we'll hear why some say that the sell-off looks overdone. Well, WSP Global is out now with its fourth quarter results, and it's recording a record backlog, improved organic growth, and strong free cash flow. My next guest says WSP shares have been hit harder than peers due to recent AI-related market pullback, but argues the sell-off is overdone. We're joined now by Jonathan Goldman, analyst, diversified industries at Scotia Capital. Jonathan, thanks very much for joining us.
Good morning. Thanks for having me.
All right. Will this report do anything to alleviate fears?
I mean, unfortunately, I think we're in a market right now where sentiment is dominating. You're seeing, dystopian fan fiction every day about what AI could do. I mean, you alluded to the backlog in your opening comments, and I think that's the key here, right? 17 billion, that represents 11 months of work. If we were going to see any cracks that AI is disrupting engineering, it would be there, and if anything, it's still growing. So it's tough to fight the narrative right there that's out there, but the results themselves, the backlog, all the leading indicators that we have suggest the business is resilient and the industry fundamentals are actually really strong.
And are they working with, obviously, I'm guessing they're working with AI. How are they implementing it? How is it going?
It's a good question. We actually spoke to the company last night, and what's interesting is a lot of the conversations that they're having with customers is not about what AI could replace, but it's what AI could add. Mm-hmm. AI in engineering, aside from just increasing productivity, actually opens up a whole new area of services, scenario analysis, data analytics, different things that would have been maybe prohibitively expensive or maybe out of reach of lots of customers are now completely open to that whole vista of people. So actually the conversations they're having is how can we add more from AI? So your question is, how are they using it? We view WSP as having kind of the leading AI deployment franchise. They announced a unique partnership with Microsoft last year, where they're both each their exclusive partner for development of AI and deployment and also construction. And the way they're using it is not only Copilot licenses, but it's also deploying AI in unique ways of analyzing data throughout projects and getting kind of early in on the life cycle of projects rather than just the front end engineering. So still early days, but the possibility of what could be done in addition to the work they're already doing is the real upside here.
All right, and I guess real world, the TRC acquisition, how is that growing? How is that going? How's the handover doing?
Right. So we talked about the TRC acquisition, right? That was done late December. This is kind of something I think that's not getting enough airtime. This was a phenomenal deal on many levels. I mean, we can talk about the price paid, but what really this did is it gave WSP even more exposure to the power and energy segment. They did a big deal in 2024 called Power Engineers. So with TRC right now, 20% of the entire platform is exposed to power and engineering. And as you know, and I'm sure your viewers know as well, that sector is just growing phenomenally in the mid-teens, maybe even above, on all the incremental power demand that's coming, from AI and data centers. So it's funny, on the one hand, the market has a negative view on AI and disrupting all these engineering services firms, but they're also ignoring the fact that WSP is going to be a direct beneficiary from all the data centers that need to get built, all the advising and consulting to set those up and connect them to the grid. So there is a direct line actually to AI and infrastructure build out and WSP benefiting from that. So TRC was a phenomenal deal in that regard, and it really positions them as kind of the leading organic grower among its peers.
Okay, let's bring in Stantec. Get your thoughts on them.
Yeah, it was another solid quarter from them. WSP and Stantec. Again, the shame is the AI narrative, but really nice beat on the quarter from Stantec. Again, really surprising on the margins. A lot of work they're doing there. Their guidance also beat consensus estimates for 26. That was also on the margins. They're continuing to do just a really solid job controlling what they can control. And I think that's on the margin side, but also driving revenue growth, reaccelerating in the US. The outlook looks good for 26. And I think the Stantec story here is differentiated insofar as they have a little delta to bridge to meet their 26 targets that they originally came out with in 24. But they have a lot of dry powder. They haven't been as active as WSP recently on M&A. So we're actually looking for them to be a little more active earlier in the year. That could happen sooner than WSP because, as you mentioned, they're still integrating the TRC acquisition.
All right, and last one I want to bring in here is Atkins. Their shares are up slightly right now.
Yeah, so this one's performed the best of the three year to date. The differentiator here, as you know, it's part engineering business, part nuclear business. So the nuclear business, again, is a direct beneficiary of the AI build out, the data centers, and kind of this nuclear power demand that's going to happen. So for them, I think everybody is looking to the nuclear business and what that business can grow, the backlog there. They do have a nice portfolio and a pipeline of life extension projects. I think the big one that people would be waiting for would be an announcement of a large-scale nuke reactor. So those are the big ones, not the SMRs, which they do participate in small scale. But the large ones, I think that's the real hammer that people are waiting to drop. And that's also an offset to the engineering business, which I think has kind of insulated them from the broader sell-off to some degree.
And any concerns with the large reactors? I mean, it takes a while for them to get going, and B, governments change, mindsets change. Any worries about that?
It's always, up in the air. It's always a moving target. But what I would say is the nuclear technology that Atkins deploys is actually owned by the government of Canada. And they give the exclusive license for building and deployment and monitoring and maintenance and operations to Atkins. So you kind of have a de facto endorsement from the government of Canada already built in. And this isn't a technology that the government of Canada does want to export worldwide. So you're kind of stuck in having to endorse it, domestically on your home soil first. And I would also point out that the government of Canada is also financing the development of the next generation of reactors that Atkins is developing, the Monarch. So you have a pretty solid endorsement from the government of Canada. Things can change, but it does seem to have bipartisan support across governments in Canada.
All right, and I just want to go back to the AI for a second. There's been a lot of talk, I think, where people are looking at 2026 as the year that it gets implemented. In this sector, do you feel that, they're already bringing it in. Do you feel this will be the time when it goes full gangbusters and we'll be able to see if it's going to work and who it's going to affect the most, both positive and negative?
I mean, that's certainly the sentiment that markets are banding about. I think we're a long way away from that. I mean, these are really complex, high-touch projects that we're designing bridges. And I think the element that people also forget is there's a huge liability component to this as well. So whether you design the bridge or AI does it for you, the engineering firm of record who's licensed and accredited is still liable for the operation, maintenance, and whether or not that bridge actually functions. So even if there are upstarts that could design bridges, it's unlikely that people would be willing to give up the liability and just outsource that completely. And secondly, these are trusted relationships with customers that they trust WSP's expertise.
Okay, I got to wrap it up there, Jonathan. Thank you very much for joining us.
Thank you.
Jonathan Goldman, analyst, diversified industries at Scotia Capital. Coming up, Mark Carney has departed for his 10-day visit to India, Australia, and Japan. We'll have more on what the trip aims to achieve when we come back. Prime Minister Mark Carney is heading overseas on a trade mission, and Conservative leader Pierre Poilievre is speaking to the Economic Club. For more on that, we spoke with CTV's Jeremy Sherrill.
Starting in India, where trade will, of course, be front and center through all of these trips. When it comes to India specifically, Canada and India have already established that they will be working towards a comprehensive economic partnership agreement when it comes to trade, kind of a broader trade deal. At some point, it is not expected that deal will be finalized during this trip, but the formal process will begin in terms of talks between the two countries. Defense, critical minerals, clean energy, all expected to be areas of focus during this trip across the board. And it is expected the Prime Minister will sign several agreements, including memorandums of understanding throughout some of these trips. Now, India, there's a lot of focus on this India trip, specifically due to the fact Canada has only recently started the process of resetting diplomatic relations with India. And yesterday, in a technical briefing with reporters going on this trip, a senior government official basically said that if the Canadian government felt as though that India was actively interfering in the Canadian democratic process, that the Prime Minister probably wouldn't be going on this trip. That is a downplaying of the situation, a significant departure from the stance of the Canadian government since, over the last several months. It was just in last June that CSIS identified India as one of the main threats for foreign interference and espionage. So it is expected that that will be a big focus during this trip, not just the trade aspect, but the security portion that the government seems to be, trying to downplay in the lead up to this trip.
right. Of course, they were linked to a killing in this country. The India. Okay. The Conservative leader, Pierre Poilievre, speaking to the Economic Club this morning, focusing on trade and the economy. What's his message?
Yeah, a lot of people watching closely for this speech. Mr. Poilievre will, speak at length on a topic we have not heard him speak at length about yet. Canada-U.S. relations. Almost infamously now, the Conservative Party shied away from much focus on Mr. Trump and Canada-U.S. relations during the last federal election, rather focusing on domestic issues. There is much anticipation as to what Mr. Poilievre could offer today during that speech, and if he offers any kind of new proposals in terms of where the Conservative Party stands on how to address the potential threats that Mr. Trump poses to the future of a free trade agreement between the two countries. Mm-hmm. So, many will be watching very closely, and there's a lot at stake for Mr. Poilievre on whether or not he chooses to bring forward something new during this talk. So, there will be a lot of people paying close attention to what he has to say today in Toronto.
And he was speaking with CTV's Jeremy Sherrill. Market calls coming up next. Today on the show, we have Mike Philbrick. He is the CEO of Resolve Asset Management. He'll be taking your questions on ETFs. Thanks for watching Morning Markets. We'll see you back here tomorrow. Have yourself a great afternoon.